Well, disinflation continued in the United States last week, with core CPI continuing to head further below 4%, while PPI also came in much cooler than expected, allowing the market to continue with its dovish repricing as the two-year Treasury yield fell to its lowest level since the second quarter of last year, while OIS now prices around an 80% chance of the Fed delivering the first 25 basis points cut of the cycle in March. And that, in turn, allowing Wall Street to gain ground, with equities rallying for the 10th week in 11, although the dollar was a little bit more range bound. It's a busy week for financial markets this week. Earnings season continues, and we've got a jam-packed data docket here in the UK, in the US, and in China as well, leaving myself and Ryan Littlestone with plenty to get our teeth into on the trade-off this week. Without further ado, let's get into the show. Well, it is, of course, only the start of the third week of 2024, but as every week goes by, the market seems to become increasingly convinced that inflation is behind us, increasingly convinced that a soft landing is on the cards, and in turn, increasingly convinced that we are going to see a year of aggressive policy easing and rate cuts from G10 central banks. With me, as always, to break down all of the latest developments across financial markets, my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good Monday afternoon to you. How are you doing, my friend?
Yeah, good afternoon to you too, mate. Lots of aggressive talk there, I noted at the start, and like the markets have got it aggressively wrong as usual, as we're probably going to find out over the months ahead.
Well, very much so. We always do tend to see this desire to underprice tightening cycles and then overprice easing cycles. And I think 2024 is already shaping up to be a classic example of that. And the week has started with a cacophony of ECB speakers all trying to push back on market expectations. And I think we're going to see a fair bit more of that as the rest of the week goes on.
I hope not. But, well, you say that, but we've got the WEF event, which I think the Guard's speaking at 3 times this week. So, yeah, I'm looking forward to it.
Oh, brilliant. Is your Davos invitation still in the post? Because mine doesn't seem to have arrived for some reason this year. I had the private jet and my ski boots on standby, but, it's all gone to waste.
No, I had to burn it to keep warm in this winter, so these cold periods. So no, unfortunately not.
Oh, it is cold today. It is a very, very cold one once more in the UK this week. Anyway, we're not going to do the classic British thing and talk about the weather. Instead, we are going to go into topical thunder and talk about what's driving the markets at this moment in time. So I want to start with really the main topic of last week, at least in terms of the economic data that we had coming out, and that is the inflation readings that we had out of the United States. And in a somewhat rare turn of events, at least in terms of its market impact, it was actually the PPI number, the producer price index, that arguably had much more of an impact on price action than the usually much more impactful and much more closely watched CPI number. So just to run through those numbers for those who haven't seen, headline consumer prices rose 3.4% on an annual basis in December. That's up a touch from the 3.1% we saw in November. But as we discussed with the Eurozone figures last week, that's all an energy-driven base effect. So not too much concern for policymakers there. More importantly, underlying inflation does continue to fade. Core CPI coming down to 3.9% from a prior 4% on an annual basis. But as I said, it was those producer price numbers where we saw the big surprise, coming in much cooler than expected. Headline at 1% against a consensus of 1.3, and core at 1.8 against a consensus of 2, both of those being an annual rate. So, of course, we saw a fairly significant market reaction to that. You really don't need to give the market a second chance to price in an even more dovish policy outlook at this point. At its extreme on Friday, we saw the OIS market over in the US pricing around an 80% chance that the Fed cuts by 25 basis points in March. That is pretty much as certain as the market has been at any point in this cycle that the first cut will come in around 9 weeks' time. and in total pricing around 170 basis points worth of cuts over the course of 2024. Of course, you've got to recall that that's about 100 basis points or so more than the median dot from the Fed's December dot plot and the summary of economic projections, and it's around 30 basis points more than the market had been pricing this time last week. So a really significant move in both money markets and also in the front end of the Treasury curve, the 2-year rallying around 25 basis points last week. But what I think is most interesting is that you saw this aggressive dovish repricing, and that came despite the fact that we had some fairly significant pushback actually on the idea of a March rate cut from 2024 voters Mester and Barkin last week. And I think that sets us up very interesting shape as we go into this week. We hear from Christopher Waller tomorrow, or Tuesday, so today by the time this goes out, and New York Fed President John Williams on Wednesday, two of arguably the biggest hitters on the FOMC in the week right before the pre-meeting blackout period kicks in. And I think if we are going to see some pushback, it's got to come from those two. It's got to be more aggressive than we heard last week. And even more importantly, Ryan, I guess the question is the market even going to listen to it?
It doesn't seem so. I mean, those inflation numbers were pretty hot. They fall well into the sticky category. The headline going up more than expected, the core coming down less than expected. We're still a way away from target. And so the market thinking that this is all going to suddenly reverse and get down to target in 9 weeks, I think it's still on the extreme side, shall we say, and well out the ballpark. Yeah, we've had a lot of pushback. It hasn't been so much pushback that much on the March timeline, but it's been pushed back on the fact that inflation, they're not there yet with inflation. We had Bostic coming out over the weekend, late Friday over the weekend. Also, he was saying that, he still only sees 2 cuts this year. So he's not really in the dovish camp, although he was one of the big proponents of going on pause and the Fed had done enough. He wasn't really in the dovish camp. And even he's coming out saying, we're not done on inflation. We may have to keep rates high through the summer. So there is going to be a bit of a pushback. We've got this disparity between what the market thinks and what the Fed are telling us. And at some point, that's going to have to be corrected in asset prices. And I think it's going to be the market that's going to have to do it more to the hawkish side.
Yes, I very much agree on that one. And I think the other thing to bear in mind is, and this is something we've covered before, you've got to remember that central banks are probably still scarred from the experience of 2021 and early 2022, where everyone's running around going, inflation's transitory, it's all going to go away of its own accord, and then it doesn't, and policymakers get their fingers burnt. So they're really going to want to see as much evidence as they can, I think, that inflation is under control, and more importantly, that there's no risk that price pressures are going to make a resurgence, and that as soon as they start easing, they're going to have to either halt that cutting cycle or even, in the worst case scenario, perhaps even start raising rates again. So I think there is going to be this desire to err on the side of caution, to get perhaps a little bit more data than is arguably necessary before delivering that first cut. And I think that does take us into Q2 at the absolute earliest for most of the G10 central banks. And the other thing is just a logistical question in terms of timing. There was nothing in the December meeting minutes from the Fed to suggest that cuts are going to happen in the short term at the very least. So you're really saying they've got to make a pretty significant and sizable shift in their policy guidance and in the statement and in their economic assessment at the January meeting to then tee up a cut in March. I just don't see it happening at this point. I think there's a big divide between what the market thinks the Fed should do and what the Fed actually will do. And I think, as you just alluded to, that will end up resolving itself by the market pricing out a decent chunk of this easing.
Yeah, exactly that. And Bostic pretty much said exactly that. He said, if what we don't want to do is ease and then find that inflation, they use the term seesaws for the rest of the year, because then they have to try and guide rates amongst this seesaw of inflation. ECB's Lane also saying the same thing about the data. He wants to wait until they get wage data, which they won't get until perhaps June or in the second quarter. So that's when they'll start, or in his eyes, will start to think about the possibility of rate cuts. So the central bankers are saying one thing, the market's saying another. For us, that's great, because if we get extreme pricing, the likes of which we saw into the end of last year, that gives us a trade. But the problem I've got now is I think the real market, should we say, the wider market, is more balanced in terms of what it thinks central banks are going to do, rather than some of these other metrics that we're looking at that are giving these extreme numbers. So there will be a reaction. I don't think it's going to be as big as perhaps we might have hoped for.
Very much so. Right, well, we haven't spoken enough about central banks, so why don't we get on to everyone's favourite, the Bank of Japan?
Well, we can knock it in if you like, and we can talk about the weather instead. It's up to you, mate. But yeah, we can't avoid them. The Bank of Japan meeting is a week away, and we've started getting all those usual sources headlines dropping on the wires. I think we spoke about this last week as well. Two pieces of key inside information that these sources have dropped is that perhaps they might look to reduce their growth forecast, and more importantly, their inflation forecast, and particularly for fiscal year 2024. Now, on the inflation front already for that fiscal year, current inflation is forecast at a medium of 2.8%. And one source was out saying that this could be reduced to the mid 2% area. Now, as there is very little expectation for policy changes at this meeting, it's going to be the forecasts that are probably going to be very important for giving us clues as to possible changes in the spring. Now, any reduction in those inflation forecasts at this January meeting will be taken dovishly if they're moved down. But remember also that, unlike other central banks, Japan gives forecasts on their fiscal year. So 2023 forecasts are going to be valid in these next announcements, unlike other central banks who give calendar year forecasts. So really the only other possible big change or big discussion topic is going to be what they may do with YCC, and whether they're going to widen it or end it altogether, and whether UAIDA drops any further hints that they're still on the right track to end negative rates. The last few meetings he's done that. He's just dropped in little comments, little terms here and there, small things, but just keeps the market moving towards the exit door and keep them on track. So any change from that is what I'll be looking for at next week's meeting.
Oh, I don't know what's more tedious this time around, whether it's the endless debate around whether or not the Bank of Japan are any closer to exiting decades of ultra easy monetary policy, or the fact that we're going to have to talk about US politics for the next 11 months or 10 months or whatever it is. There you go. Viewers, in the comments, you can have that debate and let me know which one you want to hear less of. I feel like we could have had this exact conversation in January 2023, or probably even January 2022, to be quite honest. I think that, though, as time goes on, what is becoming more clear is that I think if the BOJ are going to begin to tighten things up this year, end yield curve control, end negative rates, it's looking increasingly unlikely that it's going to be the start of a tightening cycle. And it's looking increasingly more likely, I would argue, that it's going to be 1, 2, maybe 3 hikes, and then that's pretty much it. And I think that does put under some threat this idea where everyone, and I was included, I must admit, came into 2024, forgive me, saying the BOJ are going to be a hawkish outlier among G10 by the yen. I mean, if you're talking about 20 basis points worth of hikes, I'm not sure that really counts as much of a hawkish outlier, in all honesty. And I don't think it's going to provide the yen with much, if any, upside. But yeah, we will wait and see. I think the same thing that we've been saying for a while stands, where as and when the BOJ do eventually shift policy, it's going to be, I would argue, more of a surprise than a well-telegraphed move. But I think January, the meeting next week, is probably still a little bit early for them.
Yeah, I think so. And I'll talk about that because I'm talking about dollar yen later on. But yeah, we knew this was going to be a slow process, and it's actually surprised me how slow it's really been.
Me look like Usain Bolt when I walk around.
That's the case, but there's still plenty of trading opportunities, and I think it is more of a bigger event than perhaps you might see it, because this is historically a big change. This is a over decades long deflationary period that they've been in, that they're finally starting to pull themselves out of, and it could be a big deal. We've already seen the scale of possible moves when we had all the expectation trading late last year, and I'm not suggesting we're going to see exactly that once they finally pull the trigger on tightening, but not too many people are forecasting what the Bank of Japan are going to do after they had negative rates. Is it going to be 10 pip increments in rate hikes? Are they going to go on a hike cycle? I don't think they will either. Probably 2 or 3, like you say, is the way they're going to do it. But you never know what happens to data. If they've still got sticky inflation, it's 3-4% in 4 or 5 months' time, we could be facing a different scenario and a much more hawkish BOJ, and no one's expecting that.
No, that is very true. It is probably arguably an underpriced risk, even if it is not a sort of base case as we move through the next 6 months or so. In any case, let's move on to Blighty, and you'll be pleased to know that I'm not going to talk about the weather here in the UK. Instead, I'm going to talk about the busy week of economic releases that we've got coming up. And finally, Kyriakos has moved the graphics on, which means I can crack on with things. Ryan, you mentioned last week that there seems to be a little bit more optimism and a little bit more positivity towards the UK economy as the year has got underway. And I guess this is sort of the first time we get to actually put that to the test with some of the hard economic data that we're going to be getting. So it is a busy week, as I said. Tuesday, well, by the time you watch this, of course, the data will be out, but it's our latest read on the labour market. Now, it's still a bit of a shambles, to be quite honest with you. The ONS are still working on a new methodology for the unemployment and employment statistics. So quite exactly that. That's very, very true. So I think the big thing to focus on is going to be the earnings data. We're expecting that at 6.8% on a yearly basis, regular pay, down from the 7.2% that we saw in October. Still pretty hot. Obviously, the BOE would argue this is still incompatible with a return to 2% inflation. But on a real basis, you're looking at real wage growth of about 3%, which is a little bit more tepid and perhaps a little bit more palatable. Speaking of inflation, we get our next read on CPI on Wednesday morning. December CPI expected pretty much unchanged at 3.8% on a yearly basis. Again, that energy-driven base effect keeping the number a little bit higher, as we've seen pretty much everywhere else. The big focus, though, for the BOE is the core figure, which should dip just under the 5% handle, and also the core services figure, which should dip back towards the 6% handle. So continued disinflation, albeit from a very, very high level when you look at the CPI metrics here in the UK. And then the week wraps up on Friday with our latest read on retail sales. And of course, the retail sales report will be covering the all-important Christmas period. We had a very, very strong sales figure in November. Sales rose by 1.3% on a monthly basis. So I think a lot of spending that you would traditionally see in December was probably brought forward a month by Black Friday and goodness knows Cyber Monday and God knows how many other sales that were going on. So actually a modest fall, around 0.5% on a monthly basis, is expected in December in terms of resale sales. So it is a busy week here in the UK. The market currently seeing the first BOE cut for May. Cable has spent, well, it feels like a month or so now, probably about 4 or 5 weeks, going really nowhere far from the 127 handle. Ryan, how do you think either of those, or both, if you're feeling brave, are going to be looking at this time next week?
Yeah, well, as you're getting told off for talking too much, I'll try and keep this fairly brief. The wages data is still looking strong, and even if it comes in expected at 6.8%, I was expecting this to come down much faster after we got through those those public sector pay rises, but it's still holding up pretty strongly. CPI is always going to be important. Is it going to remain sticky? Again, we're nowhere near target to get the Bank of England expectations for cuts increasing. We're going to need to see numbers much closer to the 3% level in the headline, and that core maybe coming down to the 4% level, which I don't think that's going to happen right yet. Retail sales, we had the last few shows before in November. I said it's going to be pretty strong for that November read, and it came out that way. I thought we might get December coming in a little bit softer. It's possible, but just what I've heard from mainly the supermarkets, it seems like the shopping has switched from present buying to food shopping for the Christmas period. So we could get a bit of a surprise there, where it's either not as bad a drop as that 0.5 expected, or it's even maybe a small positive, which will end the year pretty well from the retail front. But I would expect January's numbers to be a bit, down the hole. But as far as falling off a cliff, however you want to describe it, dunking in the Thames. I think on balance, the retail sales aside, I think there's going to be enough numbers here that's going to see the BOE remaining on the higher for longer stance, and perhaps that's going to be reflective in those OIS numbers, and indeed cable. Could be a big moment for cable. As we've been talking about, there is a bit of positive sentiment in the market as regards to the UK and the pound. If we get horrendous data, like that, it's all going to change, and everything will be, blood and thunder and fiery abysses, and we're all going to sink into the ground and never to be seen again.
It'll be warning of Armageddon again.
Exactly. Yeah, it'll come out again, and we'll flip, and then you'll be lucky to be able to sell a rally before it dumps off in cable. But a big week, something to focus on, and it should be an exciting one.
Yes, very much so. And of course, we do actually have Bank of England Governor Andrew Bailey speaking on Tuesday afternoon, I believe it is, which gives him another chance to blame anyone but him and his 8 mates in that building behind you for causing the inflationary nightmare that we've lived through.
Is he skiing as well, or is he taking his dustbin lid to Davos?
I'm not going to go there. I could make so many jokes, but I'm going to be well behaved. Let's go on to the election.
Yeah, your favourite subject. I know you're going to like this one. After saying I was only going to talk about the elections once at the beginning of the year, I think I've had it every week so far. But I'm not bringing up this tropical thunder just to send you into a fit, Michael. But we do have the start of the US primaries kicking off. They're already kicked off, and by the time you've seen this show, you may have the results start coming in. Republicans would have cast their votes for who's going to be their preferred presidential candidate. This is the primaries in Iowa. Trump is in the running for this one. The next primaries after that is in New Hampshire, which is the 23rd of Jan. And that will be for both parties, although Biden won't be on the ballot for that one. So I don't know. There's probably a little for the market to get its teeth into on this one. And there's a long way to go in these primaries, obviously. But being the first one, they could set some market expectations as the rest unfold. So as much as both you and I would like to ignore the election noise from the US and from the UK, it's happening and we have to pay attention to it. So what we get from these primaries on Tuesday going to be important probably, for at least from the Republican side. And I now promise not to mention the US elections for at least a week, Michael.
At least a week. Yes, I think elections are an interesting one. I agree. I don't think they're going to become a market story until we know a lot more about the policies of, well, particularly in the US, who the nominees are actually going to be. If you want a bold call, I reckon there's a decent chance, 20, 25%, that come November, neither Biden or Trump is elected president. There's a lot that could happen between now and then. And until we know who the nominee is, I think it's very, very hard for the market to trade this sort of event. But political developments are going to be a big theme this year. Obviously, over the weekend, we had elections in Taiwan where the sort of China skeptical pro-independence parties won a third term in power. So we'll see how relations improve or perhaps even more likely deteriorate between China and Taiwan over the coming months. And I think it's something like 40% of the world's population are due to have a vote of some description this year. Of course, we'll have an election here in the UK later this year, the 14th of November, seems like the likely date. There's EU Parliament elections going on. There's polls going on everywhere. And I think it is, particularly in the FX market, going to be a big driver of those currencies where polls are taking place, but it's very, very tough for markets to price risk around political events. It is markets are notoriously poor at doing that, and of course, in turn, that does create the opportunity for volatility and for trades to be placed around these events. But in terms of the United States, it's going to get a lot of airtime. It's great for the media. I don't think it's a macro story until the summer at the earliest.
No, I think I agree with that. The only thing I would say is, because this is the first primary that we're getting for the election, maybe there is something for the market, because if there's a huge amount of support for Trump, then obviously the market's going to draw conclusions from that. Conversely, if he finishes second or has a very weak showing, that's also going to be draw conclusions for the market. So it's almost like this is the first point where the stone gets dropped. It could make the biggest splash, and then we get smaller ripples over the months ahead.
Absolutely. And on that brilliant analogy, let's move on to That's a Setup.
That's it. I've used it up.
I worry you've peaked too soon there, mate. It's
Well,
only
yeah,
our
you
second
better hope
show of the
not.
year, and we've already got these Shakespearean lines coming out. It's going to be difficult for you to top that as we move through the next 11 months or so. In any case, let's have a look at some charts. I'm going to have a look at the Aussie dollar to start things off this week. We were looking at this chart last week, and I thought I'd bring it up once again because the Aussie has continued to face headwinds, notching a second straight weekly decline and continuing to lose some ground in early trade as this week has got underway, trading below the 67 figure and around about its lowest levels in a month or so. Ryan mentioned last week, and I have added on some retracements onto the chart just for you, my friend, that we are clinging on to the 38.2% retracement of the rally that took place from the basically middle of November last year to the end of December. So this really is a key level now, this sort of 66.45, 66.50 region. If the bulls fail to hold on to that level, then we are likely to see a bit more of a sustained move lower, with the 200-day moving average at 65.85 and then the 100-day moving average and 65 figure, the most obvious levels to watch to the downside. I think the big two things that worry me here are, firstly, as I mentioned last week, sentiment towards China remains pretty dismal. Overnight, the PBOC maintaining their MLF rate at 2.5%. The market had been expecting a 10 basis point cut. So another day, another China stimulus disappointment. That's not going to help the Aussie dollar too much. And I think the other thing to bear in mind is that, as I mentioned in the intro to the show, the S&P 500 has gained 10 out of the last 11 weeks. We were up about 1.5% last week, and the Aussie dollar just can't catch a bid, which is not a great sign for a high beta risk proxy. I would be looking for a close below that 66.5 level before jumping into the trade, but I do think further downside is probably on the cards here.
Yeah, well, it's good to see you adding some new technical analysis to your armory, as long as you don't start throwing up head and shoulders, which I think is absolute witchcraft. Then you can
don't worry. If you ever see an Elliott wave, it's a cry for help.
Okay, I won't tell our resident Wizard of Waves, Gregor, about that one, but yeah, no, I'll get where you're coming from. But yeah, we've been hovering today. We've been hovering around this 66.5 level. I think if we break that 66.40, that 38.2 fib, there's probably quite some significant stops through there, and we'd probably be down to 66 or worse in a flash. So, yeah, it is a big level. It's not bouncing, as you say. It's also not really collapsing. So, and this is part of the course for a lot of FX pairs at the moment, and I'm going to talk about that in a moment. But, yeah, it's ignoring what's happening with the S&P. It's ignoring what's happening in China. So there's several alarm bells ringing, at least should be ringing for any Aussie bulls, that we're potentially going to get a bit of a breakdown here. And I think sitting here right now, that's probably the path of least resistance.
Yes, I very much think so as well. And of course, the other thing to bear in mind is if you were, for example, long since the bottom in October or November, we're 4.5 big figures above that. It's sort of the price action that would make you lean towards taking some profits off the table if you haven't done already, rather than waiting and hoping and keeping your fingers crossed that we might see a bit of a bounce. In any case, why don't you get on to that very subject of how sort of eerily quiet, dare I use the Q word, subdued markets are at the moment?
Yeah, very much so, and it's really been one of the standout features so far this year. The lack of movement in some FX pairs, and for all the washing out of year-end stuff and data we've come through so far, a lot of FX pairs are stuck in old ranges, and especially the majors, and that's all well and good for the scalpers, but it's leaving a lot of us traders a bit frustrated too. And the reason is volatility, and it's seriously lacking in a lot of pairs, bar yen pairs at the moment. Now, my key gauge for volatility is, and that's what I'm showing on the chart, is the 1 month at the money option volatilities. As you can see on the chart here, Euro dollar, cable are both sub 7%. Now, if we're below 7%, we're entering sort of low volatility territory, and above, things become more notably volatile. Now, as you can see, that's reflected in dollar yen at the moment. That's well above 9%. It's obviously natural to see the yen have higher vol right now, as we're potentially seeing big changes coming from the Bank of Japan, whereas all the other central banks, while we may be playing the cut game, it's still only about rates settling down after a big hike cycle. Now, as you can see from the chart, that was reflected in higher vols for most of 2022, 2023, when we were going through all those rate hikes. Now, what you want to do as a trader to read these vols is as a guide for how pairs are likely to react to things like data and headlines. Now, we've seen it. We saw it over the NFP and ISM, then CPI and PPI. We do get moves, and dollar yen moved more than both euro dollar and cable, and the same for others like Aussie dollar as well. But those moves didn't last, and we've usually come right back to where we started soon after. Now, low volatility usually means tighter trading ranges and less appetite to break to new areas. So factor them into your trading and expectations for price moves. That's what helps you when you're trading. You get in a trade over a data point, don't go expecting hundreds of pips out of something like euro dollar when all the evidence suggests you're not going to get it.
Absolutely that. Very, very well said indeed. I don't really have anything to add to that, to be honest, apart from to say that I think implied vol is a very, very important tool to have in a trader's arsenal. Having that expectation and that gauge of how the market is likely to move around key events is very, very important. And the other thing I would say is I would question what causes this to pick up. And the obvious two things that spring to mind are either a victor in that battle that we were discussing earlier between the market and central banks in terms of rate cut pricing, or perhaps some sort of black swan geopolitical flare-up, which obviously we hope doesn't happen. But besides those two things, it does seem that vol is set to just plod along or even continue grinding lower, which does make for perhaps a little bit of a frustrating market and some frustrating trading conditions. But I think that's where really, particularly for the more medium and long-term traders, patience really does become the name of the game. Don't go rushing into positions just for the sake of it. Be aware and cognizant of the market that we're dealing with and adapt appropriately.
Yeah, I think there's going to be enough this year to keep vols from really coming down. I mean, we saw it after the COVID period. You can see there we had the spikes there coming through COVID, coming out of COVID, and vols, particularly in dollar yen and euro dollar, were down around 5%, and things were abysmal. We were getting 20 pip moves a day. So I think there's enough going on geopolitically and with central banks to keep those vols just around that probably 7-8% area. Dollar yen, as I said, a bit higher, which should give us the moves, but it's probably going to keep ranges contained, as I say, as well.
Yeah, absolutely. And no prizes for anyone guessing what caused that massive spike in the orange line in 2022. That was when Liz Truss and Kwasi Kwarteng tried to blow up the gilts market. In any case, let's move on to the commodities space. I wanted to talk about WTI. We just touched on geopolitical developments. And I think crude is an interesting one at the moment, whether you look at WTI or Brent. Because there's not really a lot going on in terms of price. We seem to be stuck within this very familiar range, which is roughly between $70 and $75 a barrel, or maybe $1 or so either side of that. I just find it interesting how the market is not really taking too much notice of what seem to be increasing supply risks. Obviously, we've got continued tensions going on in the Middle East. We've had news on Friday of an oil tanker being seized by Iran in the Strait of Hormuz. That would obviously be a big worry if we were to see these issues with shipping spread to the other side of the Middle East. The Red Sea is obviously still on the radar, but if we start to see that escalate in the Strait of Hormuz, I mean, you're looking at sort of 15-20% of global oil transiting that strait. So that would be a really, really, really big concern for the market. But I think the lack of any sustained rally and the way in which any gains have been fairly rapidly sold into just speaks to me how actually fundamentally it is demand rather than supply that remains the main driver of crude, and the demand outlook remains pretty dour. Let's be honest with you. We've got some data coming out of China this week. We've got GDP, industrial production. Obviously, they'll be made up, but I think they are going to be key for the market this week. But the failure to break above that 50-day moving average on Friday is likely to be a little bit of a concern for the bulls. If you put a gun to my head, I would favor crude moving lower, but I would also just say that if you are going to be short crude, be incredibly careful and incredibly nimble, because this is a sort of situation which is very fluid and it could and will change very, very quickly. And I think as a result of that, if you are going to be trading this from the short side, it's important to be following the headlines very, very closely. And to quote the old adage, never be short crude over the weekend.
Yeah, sage advice, very sage advice. I think you're 100% spot on there. I'm surprised. In one sense, I'm surprised crude isn't much higher. And when we saw it picking up on Friday, late last week, when the US and the Allies started fighting back. But it is still very much in its own little bubble. It's not drawing in any of the big major oil players. And I think that's part and parcel of why we're not seeing any really significant moves in oil. And yeah, on the demand side, that issue isn't going away at all. We've seen that in the manufacturing numbers across the globe. Fundamentally, you see no real reasons why oil should go higher on a fundamental basis. And I think until that changes, then the upside is very limited outside of this risk that we got in the Red Sea at the moment.
Absolutely. And I think if we were to get a big pop higher, whether it's Brent or WTI, as I said, it doesn't really matter. But let's say we got a big move higher in WTI back towards that $80 a barrel mark, where you've got the 100-day moving average and those highs from November last year. If it is a knee-jerk move on a geopolitical headline, I'd argue it just gives you another better level with which to enter a short and fade that move. But again, those caveats around position sizing, of course, apply.
Yeah, absolutely. I'll be looking for exactly that big level up towards that 80 that we've tested and held. So, yeah, that sounds like a good trade, mate.
Well, there we go. Great minds think alike, or fools seldom differ. Only time will tell. In any case, you've only mentioned the yen in 2 of your 3 segments so far. So why don't we make that 3 out of 4?
Okay, I'll go for the hat trick. How about that? And the potential for another Bank of Japan pop. Now, I looked into this, and dollar yen popped higher during all but one Bank of Japan announcement in 2023, and that happened to be the January meeting last year. So the theme for seeing raised expectations going into a meeting followed by a quick unwind could continue into the spring, and when we possibly finally get confirmation about them ending negative rates. Now, as we know in trading and all investing, past performance isn't an indication of future performance. But if we are to see any last-minute hawkish expectation trading in to the market ahead of this Bank of Japan meeting, i.e. stronger yen going into the meeting, we can largely expect the price action to follow the same theme as it did last year over the announcement, and then a sharp move of yen selling. Now, technically, we're still mooching around this 145 area. Today, we're up closer to 146. The next main resistance I have is around 147. Support at the moment looks pretty firm into the 144 big figure. So quite a wide range for us to play with there. I'm still looking to play this from the short side. I'm still keen to play a Bank of Japan trade, them ending their easing and getting on the hiking. I'll continue to try and take partial profits on shorts as soon as possible. You've got to be nimble in this one because it helps cover the carry costs from sitting in shorts for any length of time. So I'll be looking for perhaps a BOJ-inspired pop to 147 to try shorts once more, as long as they haven't changed to a far less hawkish stance or indicated any delays in ending their easy policy, potentially by those forecasts. So still for the short side for me, but I'm going to be picky and choosy, and I want to take profits quickly when they come.
That's a very interesting stat there, the kind of whole buy the rumour, sell the fact thing that's been going on around BOJ decisions for about a year or so. I hadn't realised that, but I think it just speaks to sentiment and perhaps even positioning in the yen, where every man and his dog is expecting the BOJ to become incrementally more hawkish every time we hear from them. And if that doesn't happen, then you see those views and those positions very, very quickly closed out and that reflected in the market. I think that's a very, very sound idea. I think overall, though, I continue to see the yen, at least for now, until we get a bit of a clearer idea when the BOJ are going to come out of negative rates and YCC. I think this is purely a play on treasuries. I think it is just a rates play, as it was for much of last year. But we will see what Ueda and co deliver next week for us.
Yeah, exactly. And it's been a bit strange because this one's been off the correlation with yields at the moment. We've got 10 years, still sub 4%, and this one's creeping higher, and usually they move the same direction. So that's why I'm thinking we're in the orbit of the Bank of Japan now, and maybe that influence is just starting to have a feel in yen pairs.
Well, it's only a week away. In any case, let's have a look at our plays of the day. So I'm going somewhere even colder than the UK for my play of the day this week. We're going up to Scandinavia.
You said you weren't going to mention the weather, and you've mentioned it literally every topic.
What can I say? I'm an Englishman. Of course I'm going to mention it in every topic. Right, we're looking at the Norwegian krona against the Swedish krona this week. I think this is an interesting one, and it's a bit of a kind of classic central bank divergent story and a change in the flow dynamic going on here. So what are we looking at? Well, the Norges Bank are a bit of a hawkish outlier among G10 central banks. They delivered a surprise 25 basis point hike in December. They look to have a real inflation problem. They're sticking to that higher for longer guidance that got drummed into us for most of the last 18 months. And of all the G10 central banks out there, they look the most likely to stick to it. Meanwhile, the Riksbank in Sweden look like they are going to cut rates a little bit sooner than the Norges Bank, perhaps even as soon as the tail end of the second quarter. They do tend to historically follow the ECB a lot more closely than their counterparts do in Norway as well. But I think what's most important is the fact that the flows are starting to change. We saw, and we covered on the show towards the back end of last year, the Riksbank were hedging their FX portfolio. They were buying the Swedish krona to try and prop it up against both the dollar and the euro. Those purchases are now coming to an end. So that sort of artificial support for the currency is going to disappear. And that is happening at the same time as the Norges Bank are cutting the amount of Norwegian krona that they're selling by around 3/4. So I think when you put all of that together and then you add in the fact that we are pretty much at this big psychologically important parity mark and we're trading bang on the 100 and the 200-day moving averages, I quite like this one for a little bit of medium-term upside, a stronger knocky against the stocky. Ryan, where are you this week?
Me, I'm looking at the S&P, something that you like to look at a lot.
I get slagged off every time I bring this up.
Well, I'm looking at a trade for this one, so I'm happy to take the limelight from you for once, Michael, and you can get back on it next week, probably after I've lost money on it, but hopefully not. Now, this one is a bit of a mix of gut feeling and price action feeling. My gut says that we're going to break this 48 zone. It really is a big, heavy top that we've got in play here. It goes back for several years, so it's really strong. We've had several attempts up here, and the price action is looking like it's building up for a break. Also, the dips are shallow. We came through the early bank earnings without too much fuss, and certainly nothing that turned the picture bearish. And the fact it's looking a big level up here with multiple tests now gets my radar sort of singing that a break might be quite volatile. Now, nothing is ever guaranteed in trading, so rather than just buy at market and close my eyes and hope for a break, a stop entry trade can be a way of catching break moves while keeping the risk low. And if we don't break the level and trigger my trade, then I lose nothing if I'm wrong. So I'm looking for a break here. I've got stops, buy stops just above the recent highs, and hopefully if we get a break, it's going to have some legs.
Well, there we go. Get the order in and then get your S&P all-time high hat ready for next week, because I think we're going to get there very, very shortly.
Don't dare me. I'll have one.
I'm sure you will. I need to get one. Right, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as he always does. If you've enjoyed the show, please leave a like on the video. Drop a comment as well. Let us know how you're trading the markets, or if there's anything you would like us to cover this time next week. And that is when we'll be back with another episode of The Trade-Off to digest all of the latest goings on in the markets and give Ryan another chance to talk about the Japanese yen. In any case, thank you very much as always for watching, and we'll see you next week. Goodbye for now.